Good morning and a warm welcome to you to our first investment review for 2022. If we look back at the performance of the asset classes during 2021, I think the most dominant factor that drove the performance of the various asset classes was the amount of liquidity that was created by central banks both in America and in the rest of the world. That increased liquidity stimulated the demand for financial assets and drove the prices of equities and property in particular during the calendar year 2021. On the back of that, we thought that investors will be rewarded by being invested in risky asset classes, and the risky asset classes, just to recap, of course, are the investments in equities, both globally and locally, and property. And as the year turned out, it's exactly what has happened. But I think, with all honesty, what has happened is that the outcome was much better than what the market expected. If you look at global equities, in dollar terms, global equities returned about 22%. In rand terms, it was well into the 30%. And within global equities, most of the action happened in the US as a result of liquidity, firstly, but also as a result of very good earnings that was generated by information technology companies in particular. So the NASDAQ returned 38% in US dollar terms, or a return of more than 40% in rand terms. If you look at the other asset classes, we've also seen a very strong performance from global property with a dollar return of well into the 30% for investors. If you look locally, South African equities really had a very good year. The overall return was 29% of the all-share index. Now remember, we've always said that we expected those asset classes to do well, but we certainly didn't predict returns in the vicinity of 30%. The contrary of that was that the so-called non-risky asset classes did not do well. What are those? Cash, of course, with interest rates being very low, cash didn't return much. In South Africa, less than 4%. If your dollar return was less than 1% for cash. And then very importantly, because quite often people, when they build portfolios, they include global fixed interest assets. Those interest rates were very low. When you commented about that extensively last year, where we said it didn't make sense for us to buy a 10-year US government bond where the yield would be negative, and in Europe for most of the year those yields were negative, and in fact those returns were really underwhelming. So just to get the pecking order right, so it was risky assets with equity and property doing particularly well. Cash, you didn't lose any money, but for bonds in certain cases you certainly lost money. Finally, bonds in South Africa with the high yields ultimately yielded a return of just shy of 9%, which was a pretty decent return in what was actually quite a very uncertain environment for the South African economy. So that is the past. More importantly is, how do we look at the future? Now, I've seen a note written by a journalist that he says it's absolutely tired every time when you start the year and you ask an investment analyst, what is it going to be all about? They always say one of two things. It's all about equity selection, or if you're a macro analyst like I am, it's going to be a very uncertain year. So the one thing that I can tell you, the uncertainty, that is just par for the course at the beginning of the year. The equity selection is probably true, but I think this year, what will be the most important driver of the performance of asset classes and, in fact, individual assets will be how monetary policy is going to pan out in America and in Europe and in South Africa. Why do I say that? I've always said in previous conversations that we had, I've always said that interest rates is the most important price. That is the price of money. The price of money in the world and in South Africa was relatively low. That meant that other assets that price off that lower price got an inflated price. I'll put it in simple English. If interest rates are low and you value off low interest rates, it means that equities and property deserve to trade on higher valuations. If you see interest rates going up or the price of money going up, then the rating of those assets normally comes down. In other words, the prices that people are prepared to pay for equities or property needs to come down. Now, it is very clear that the big surprise last year was high inflation. And the big debate last year was whether this inflation trend, whether that would be transitory or not. Should it be transitory, there was no need for monetary authorities to hike interest rates unduly higher. However, as it turned out, it seems to us that inflation in the short term is certainly more sticky. In the recent Fed's meeting, it was quite clear that the Fed has become more hawkish. And after the press conference that the Fed had, it was quite clear that the market then adjusted their expectations for interest rate increases up higher. And it's now quite likely where the consensus was for 4 hikes that we are likely to see 5 hikes. What does that mean? If those extra hike was not priced into equities or into the property valuations, it means that the market needs to adjust. And that brings the risk that those prices can come under pressure as the year progresses. Another factor that we need to consider when we talk about the performance of asset classes, of course, is what will happen to economic growth. Because ultimately, if you have decent economic growth, it creates an environment where companies can generate decent earnings. And when we buy shares, we want to buy the share for the share's ability to generate earnings through the cycles. Now, the first thing is that we need to say is we don't predict a recession for 2022. We predict the very strong momentum in economic growth that we've seen in 2021. We predict that will come under pressure and that the momentum will slow. But the cocktail of higher than expected interest rates and slower economic growth is likely to lean on the prices of those risky assets, and therefore we have not changed our view. We stick to our view that we had last year already, that we need to recalibrate in terms of our expectations for performances from equities and property and bring them down well into single-digit territory. We're certainly not forecasting a bear market as a base case. We would be highly surprised if we have a repeat of double-digit returns for both equities and property. The dilemma that we sit with, unfortunately, is if equities and property is not attractive for 22, what is attractive? Well, cash will still only yield 1 or 1.5% if interest rates go up. Bond yields are still trading at low levels. In America, less than 2%. In Europe, just above the zero line. So even those two asset classes, from a returns perspective, doesn't provide a long-term solution for clients. So therefore, I think this year is just a year that we must expect that overall returns will be lower. We still favor, through the cycle, we still favor equities and property to do better than cash and bonds, but we need to warn that the returns coming from those two asset classes will be more volatile and will certainly be lower. I think it is also important at this point to say something about global equities. What we've seen last year was that the market favored 2 areas. The market favored information technology shares because they produce wonderful earnings, but they also traded at very, very inflated valuation levels. In other words, simply, they were very expensive. And we warned against that. What the market did last year, the market also started to rotate out of some very popular sectors into what we call the value sectors and cyclical sectors. Those are banks and materials or resources as we know them in South Africa. We think that those 2 sectors can continue to do well. So the one thing that has changed over the last 6 weeks or so was the fact that interest rates views changed, and that rotation that we've seen happening gradually in 2021 accelerated over the last 6 weeks. So information technology shares got sold down, materials or resources shares got priced up, and banks largely held onto their valuation levels. We think that process is likely to continue into 2022. So when we talk about the market in general, and we talk about the expected lower returns for 2022, I think it's not going to be a blanket market. In other words, where sectors perform very similarly. The disparity that we've seen within economic or financial sectors within the equity market, we are going to see a repeat of that in our view in 2022. But last year's winners might well not be this year's winners. if you look at our portfolios, if this view comes true, particularly on our global equities, we think our portfolios will relatively benefit from this scenario that I've just sketched, and therefore we think we are correctly positioned. During last year, we've already taken some money off the table from the equity markets in our multi-asset portfolios, so we are running on a neutral stance in terms of global equities. South African equities is slightly different. Although they are highly correlated to global equities, the one thing that we can say is from a valuation basis, they are certainly not expensive. In terms of its own history, it's trading at a price earnings multiple of about 11 times. That is lower than its long-term mean. In other words, on average, it is cheap. And if you look at the quality of these shares, their balance sheets are nicely rebuilt during the recovery of 2021. So the balance sheets are sound, the valuations are not expensive, and I think the market is also quite sanguine in terms of the expectations in terms of earnings for these companies. So when we put our portfolios together, on balance, we have overweight equities, neutral to underweight global equities, but overweight South African equities on a valuation basis, because we just think that with the macro environment within South Africa, there's just a lack of interest in some of these shares, and our clients should benefit from that because we think over time that value should be unlocked to their benefit. In summary, uncertainty will always remain part of the investment markets. However, this year, the outcome of inflation will dictate monetary policy, and if we do get surprises, investment sentiment will change, which means that volatility will be part of the investment landscape for 2022, just as we've seen it already happen in January. From a performance perspective, though, we will not see a repeat of 2021. Performance will be more muted, and I think during the year, our resilience will be tested in very volatile markets, which will ultimately create investment opportunities for this investment cycle.